While the rest of the developed world frets about faltering growth, Australia's jobs boom continues. Today's figures from the Bureau of Statistics show almost 50,000 jobs were created last month, reviving fears of an interest rate rise and driving the Australian dollar to a record high. Here's Philip Lasker.
There was only one way to interpret these numbers.
Exceptionally strong for the second straight month, and the best part about it was all the jobs were full-time.
Employment rose by almost 50,000 in September, more than double expectations. More people entered the workforce, but the jobs growth was strong enough to absorb them, keeping the national unemployment rate steady.
The labour market is showing that the economy earlier this year was very strong. We think it's weakened a little bit since the middle of the year, but there's still lots of jobs out there.
Unemployment fell in all eastern states and territories except New South Wales, and it was in some of the resource-rich regions like the Northern Territory and Western Australia where unemployment picked up.
It looks like it's a pretty broad-based gain, and it's the big employers of the economy like retailing and even manufacturing and finance that's where the jobs are being created. It's not just in the mining sector.
The jobs surprise helped boost the Australian dollar above 99 US cents to its highest level since floating 27 years ago.
Unemployment is getting towards levels that some people think would basically be around our natural rate. In other words, if it goes much lower, you'll start to generate wage pressures.
And so markets have raised the odds that the Reserve Bank will raise rates next month.
I think it's very likely they will hike in November, but it's never a certainty.
Partly because of the fragile global economy. The IMF trimmed its global growth forecast in its latest World Economic Outlook, saying the developed world faces subdued prospects.
World economic recovery is proceeding, but it is an unbalanced recovery. It's sluggish in advanced countries, and it's much stronger in emerging and developing economies.
Emerging economies were forecast to grow nearly 3 times faster than rich nations next year, mainly because the rich nations need to repair their battered finance sectors and rein in government debt, consumers need to save, and house prices need to recover.
Bottom line, this is what leads us to predict low growth for advanced countries. The relevant numbers are 2.7% for 2010 and 2.2% for 2011. With such low growth, we forecast that the unemployment rate will remain very high. The numbers here again are 9.6% for the US in 2011 and 10% for the euro also in 2011.
There was even a note of caution for the Australian economy. The IMF says house prices here could be mildly overvalued and vulnerable to a correction, which could hurt confidence and household spending.